Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
The bear markets are coming. The bear markets are coming. They are sometime. We just don't know when, and that's the whole point. Folks, happy July 4th. This is our early edition on July 3rd. We're taping right before going into the early close of the market today, Wednesday. And we want to wish everybody a happy July 4th. I'm wearing my patriotic shirt. It's kind of hard to see with the flags and the fireworks bursting in air. Folks, we named our company Revere Asset because we love this country, but also it kind of dovetails with our strategy that we want to warn investors of danger, of when to get defensive. That's why the portfolio is named Growtection. You want to try to grow it when the market's good and then protect and get defensive when it's bad. So in any event, we are doing the show early, but we wanted to give deference to our country. Now, the show is still writing itself, with Vanguard telling customers, hit the road, Jack. Don't you come back no more, no more. Hit the road, Jack, and don't let your door hit you on the way out the door. Vanguard is actually telling clients, we'll terminate you if you call too much. If you call us too much, it's not customer first anymore, it's digital first. You need to go online and try to resolve your problems, and then as a last resort, then you can call us. Now, they're trying to figure out other fees like exit fees if you're not happy, or other fees, because yes, they got that low cost ETF structure and mutual fund structure. But guess what? They have to make it up in other ways, folks. They got to make it up in other ways. And I love Don's favorite quote. Vanguard's a cheap way to lose money fast in a bear market. So in a good market, they're great. They're fine. If you want just passive beta exposure, they are the beta player, right? But in a bear market, they're just like everything else. They go down with everybody else that doesn't have a sell discipline. Anyway, there's a whole article on that in the show notes. It's called Vanguard Warns Clients to Hang Up and Log In or Else. You got to love it. All right. The other articles are still trying to justify putting money in other areas. So one article, and I'm not going to go into these, you can read these yourself, they're in the show notes. Is small cap exposure still a good idea? Asking for a friend. That was by Russell Investments. You always want to look for the promoter or advertiser. I'm not saying small caps are good and bad, but it's asking if it's still a good idea because they've been dogs for the past decade. It's actually if they're saying, is it still a good idea, you should sell it, it's actually probably a good idea to buy. If they're saying, is it still a good idea to hold on? I'm just saying. And then Liz Ann Stonders says the stocks are showing bearish signals. She's talking about the large cap, big tech doing well and carrying the rest of the market, why this bearish divergence, and she compared this to 2021 when you had a few stocks going up while the rest were dropping off, that led to the bear market in 2022. So she's talking about this divergence is concerning. Welcome to the party, Liz Ann. We've been talking about that for a couple months now. And then lastly, and this is my favorite, how investors can avoid emotion-driven stock picking and investing. Oh, I love that article. And that is what this show is about. And that's what Revere is about. Now, remember, a week ago, I read you that article. What was it? The great bear market in diversification haunts Wall Street pros, because they're trying to justify this diversification's not working. It's just the large caps that working. So what do? Do you throw in the diversification towel and say it's not working, or you just wait because it's day and the sun will come? How long will that be? Well, we're going to talk about that, and the whole reason today, what we're going to do is we're going to do something a little different. We're going to go straight into what we did for the past month. We're going to go over a couple of trades. We're going to show you some we picked that worked out, some that didn't work out, some that broke even. But we're going to show you how we identified that stock and decided to take a position, and then kind of how to manage that position, whether it works or not. Now, the one thing I did like about this, how investors can avoid emotional driven stock picking market, it's one of the very, very few articles now. He just goes in this in very shallow detail, but he's talking about how, Peloton and Zoom during the COVID crisis just skyrocketed, but as soon as the economy opened up, they struggled. And he was talking about how do you differentiate between investing and speculating. And he's got a good point. He's talking about leading stocks, but then he said it's not just the stocks. You got to use some technical indicators like relative strength, momentum, money flows, and stochastics. Folks, he is one of the few people that I've seen that is even, besides us, that's even talking about technical analysis. Everybody else is saying, spread it out, put it in a pie chart, set it and forget it, and hope for the best. That's not what we do here at Revere. So with that, I'm going to go straight to the guys. We're going to get straight in the markets. Pardon me, I didn't do the mailbag this week. We just did the show last Friday. I got a few in this week, but we've been kind of busy, and I thought this was more important. So guys, with that,
who's
Don,
the author on that? Who's the author on that article, Dan? That last one? I was talking about technicals, and
I just threw it over there. Let me see. It is Russ Allen Prince. Russ, and he's got a either a kind of a money management firm, or it's a one of those newsletters that sends you alerts and stuff. But like I said, as well as I do, now, folks, be careful, because there are people online sending out newsletters where they get out of being an advisor, of getting advice. They're not licensed, so they can send you all kinds of stuff. Oh, this hit a buy signal, this hit a sell signal, but they're leaving you to do it and manage it and do what you want. And they don't keep a track record. They don't keep track of all their wins and losses. And it's easier to kind of cherry pick and hide. And they're not licensed, they're not regulated. So you got to be careful and distinguish between a real registered investment advisor, a licensed person that hopefully is a fiduciary, because it's your money. It's not Wall Street's money. They think it's their money. And if you're working with a broker that works on commission, guess what? It's their money. They're doing products normally, not strategy. So first, you need to make sure that you get advice, and the advice is independent from a fiduciary, and that is only by the buy side. But that's alone is not enough. You still need good strategy. So just because they're a fiduciary, that's just the way they get paid. But if they still are doing a passive pie chart, you're going to have to be able to put up with 30-35% drawdowns every 4 to 5 years, because it happens. Okay? Modern portfolio theory way underestimates the number of bad outcomes. It is not, folks, returns don't fall under the bell curve, the normal standard distribution. So basically, in plain English, I'm not going to dive deep, they're measuring for the 100-year flood, but it's coming every 5-6 years. Okay? They're underestimating the risk. That's why what you hear and what they're telling you with your diversified pie chart and your actual experience with drawdowns and how much you lose during bear markets does not reconcile. That's the difference. So with that, I'm going to turn it over to Don, and he's going to show us a better way. Go, Don. I teed you up, baby. Come on.
All right. I won't ask you another simple question, because you might talk for another 20 minutes. So let's get into the markets.
I'm going to make you get on a horse and take the lantern. I'm going to make you be Paul Revere.
Here we go. All right. We're looking at the S&P 500, and we've been talking for a while, every night in the videos, about this tight range that the market was trying to break out of, 54.47 to 54.91. So let's go to a 60-minute chart. Every once in a while in the market, while it's trying, you get a candle that's a little bit scary. And basically, it's called an outside negative reversal. You see them several times on this chart during the most recent move up, and sometimes it's a one-day wonder, and you consolidate for a couple days and then go higher. Sometimes it's the sign of a breakdown coming. Now, a breakdown could mean short-term time frame, intermediate-term time frame, or lead to a long-term time frame. And we don't ever guess. We don't know which way these are going to resolve. But back in April, we had a negative reversal. We went sideways for a week, and then we broke down through the 21-day and 50-day moving average and ended up stopping at the 100-day moving average. We got pretty defensive on this, and not by choice. It's by our stops being taken out. Every position we have in-house, we have a stop for. And then we look for some signs of a bottom and or a follow-through day, and we got back above the moving averages in early May, made an attempt up, and then just really let's look at technical analysis 101. We broke back above and we consolidated for a while, and then we got another negative reversal in mid-May. I'm going to go to a 60-minute chart on this and point. So we're trying to break out. We get a big negative reversal. And the question is, how is it going to resolve itself? We went sideways for a couple of days, and then we broke down through the low of that day, put in a declining tops trend line, and then at the end of May, beginning of June, we had a strong close the end of May. We went back and forth in June 1st, kind of went sideways for a little while. But what we're looking at is what's the prior high and can we get back above it? Simply trend following is you're looking for a continuation of higher highs or lows. Higher highs meaning very obviously you're making the uptrend is continuing. You're going higher, and we track this over 3 time frames. So early June, we make a higher high. We go sideways for a little while, and then we get a nice gap up. So obviously, anytime you get a gap up, you're wondering 2 things. One, is it going to hold? If it isn't, is it going to fill the gap? In this case, this gap has never been filled. So what it ended up doing is just going sideways for another 3 or 4 days. Markets can only do one of 3 things: trend higher, trend lower, or go sideways preparing to trend higher or trend lower. So we got to break out above this early June level in mid-June, and then same question goes back above. Are we going to break out? We're going to trend higher, or is it going to be a failed breakout? That breakout level was 54.47, and we got back above it on June 17th. So the question is, how high are we going to go? In this case, not much higher, trended up for a couple of days, and then we had another outside negative reversal. So the same thing, same question: is this going to lead to lower prices? Are we going to go sideways for a little while, or ultimately are we going to break out? I'm going to switch to a 30-minute chart here to get a little bit more of a granular detail. So here's the 54.47 level that we broke out of, and look at how we've been obeying this level. Again, people say technical analysis doesn't work. The algorithms are using technical analysis. So if you think it doesn't work, that's your opinion. Algorithms are programmed to use it. So there's 54.47. It's a breakout level. You test the breakout level, and does it hold? It was tested many times over the last couple of weeks. Most recently, just 3 sessions ago. Then when so we're holding the bottom, we're holding support. What's the next breakout level going to be? Well, it was around 54.90 is where we paused. We had a failed breakout above 54.90. That's okay. We came back. All we did is test prior resistance that now became support. As long as support's holding, it's okay. There's another attempted breakout. Broke out, but again, just for less than half day, then a hard negative reversal. So then the question is, oh, geez, hard negative reversal. Are we going to go lower? Is this rally ended? No, all it did is come down to this 54.47 level again, stay back in the range, and then late day yesterday on a holiday weekend, we've been talking about how there's a positive bias in the markets for the first 2 weeks in July. And that's what happened. Plain and simple. We broke out Tuesday afternoon, and we've been on a trend up ever since then. we're trend followers here at Revere. We're not going to argue with the markets. If it's going higher, we're going to go higher with it. We're not the people that are sitting there getting more bearish the higher the market goes, because that's having an opinion. And in this case, that opinion is wrong. So plain and simple, we take a look at the range. We take a look at the trend. If support is holding, great. Then what's the next resistance level? If we get above it and we continue higher, great. We're going to continue riding the wave until the wave stops. And that's plain and simple what's going on with the S&P 500. We focus on the S&P 500 and not the NASDAQ because of diversification. All rotation from growth to value, from sector to sector, takes place within the S&P 500. We want to be in the sectors that are working and minimizing the sectors that aren't working. So we resolve to the upside right now, and we're going to continue to ride that wave. And we do have an eye on mid-July. That's typically the weak time in the market is late July, August into September. This is just historically speaking, it is an election year. That's typically more bullish. So we're factoring that in, but those are secondary indicators. We're just watching the price at levels and the moving averages. And we have different rules insisting that we be in the market regardless of what our opinion is, regardless of the lack of breadth. Price is primary, and that's what we're focused on. So there's our breakout of the S&P 500 yesterday above that 54 90, 91 level, and now we're at 55.22 as of right now. Leading into noon on Wednesday, we're closing and the market's back on Friday. Then we've got the second week of July, which again is historically bullish, and we're looking for low risk entries in leading stocks and leading sectors, as well as our index long in the S&P 500, and just riding that to higher account balances for clients, along with higher highs in the market.
Okay, so so that 54.90 has now become support. It was resistance, and now it's become support, and you're looking for the next leg up,
right?
Until proven
and
otherwise.
Any pullbacks, we want to see 54.90 hold. Any pullbacks, that would be that what was former resistance now flips to support, just the same way at that 54.47 level, where we broke out of it back on June 17th and then tested it multiple times: June 20th, June 25th, June 26th, June 28th, and then we broke back above that 54.90 level that was capping we were unable to hold above it twice, but third time was a charm, and we got back above it yesterday, and that's the level that we'll be focused on right now, is 54.90.
All right.
So now we're going to go to the guys. They're each going to go through 4 trades that they went through. A couple of winners, a couple of scratches, and a loser or two. We bear all. We have nothing to hide here at Revere. We do videos every night dictating our trading strategy and actual changes that we're making. The most transparent advisor in the country, probably in the world. Let's get to it. Connor, we're going to start off with a First Solar trade, and this has really been an interesting, a lot of lessons in the action in First Solar here, so take it away.
Yeah, so thanks, Don. So first winner is First Solar, and so my thought process going into the trade was that TAN, that's the solar ETF, that was putting up a bottoming base, and this was the clear leader. On this daily chart, you can see that base on base and a lot of accumulation in that base. And so that got my eye to it. And the other thing with First Solar is that the earnings estimates, going out to 2025 were super high. So my first buy on First Solar was on 5/3 at $191 a share. And this was right when it was breaking out of that mini base on volume. And that was my starter position. I was risking just right around that low, the base. So that was about a 5% risk. And so this continued to show strength. And then on 5/13, I added to the position again at $193 a share. This was a buy in the base. The 60-minute stochastic got pretty oversold, and I liked how this it was just right at the 21 day getting super tight in that base on base formation. And yeah, so after that, it started to shoot up really quickly. Once it broke out over that base, it had huge volume. And, I don't think anyone was expecting it to shoot up this hard. And yeah, so it ran about 40% pretty quickly. And then on 524, I sold half the position at $270 a share. So that was a 41% gain. And then it continued higher, right? So it had that initial thrust.
Connor, why did you sell that first position? Was that just because you're taking some profits? Was that a proactive profit harvesting, or what was the reason?
Yeah, so it was a combination of a couple of things. One, I don't remember exactly, but this was almost 10 ATR above the 50 day. So historically speaking, if you look at runs in stocks, once the stock gets that extended from the 50 day, it's often a good time to take some off. And it was 12, 13 times my initial risk. So based on trading stats, that's, that's a
very extended.
That helps boost the equity. Yeah. So I took some off and I raised my stop to 250. And the reason I raised my stop to 250 was that was the high volume close on the breakout day. It was too much of a holding down to the 50 day would have given too much gains back. So that was a key level. And so, yeah, after I sold it, it shot up more. It came right into that 300 level, which is obviously a little more psych level. And then it came off. And then, so right when it started, it had 3 harsh down days into the 21 day. And usually that's a good bounce spot. My expectations were for this one to bounce. And it wasn't able to bounce, and then it sat right on that 250 level for a couple days, just not able to bounce. And the other big thing was the sector was falling apart. This was like the lone wolf in the solar sector, and everything else was squatting extremely hard. And the ETF actually just made all-time lows the other day, so that was another red flag. But I wanted to give this one the benefit of the doubt. And then on 626, I sold the remainder of the position at $249 a share, which is around a 34% gain. And now it's much lower. So that was the trade. It was a good trade. My expectations were for this one to go higher, but your stop's your stop. And that was the final piece that I got out of the position. And it's in the sector, the name's honestly completely fallen apart. So see if it sets up again in the future. If not, done with the name. Second winner is pure. Sorry, Don, you say something?
No, you're exactly right. You don't give back your gains. That's the compounding gains is the foundation of what we do at Revere.
Yep. Second winner is Pure Storage. So I bought this one on 5/6 at $53 a share. This had a strong earnings gap. And then after the gap, it pulled back, tested the low of the gap once and twice, and then started to consolidate. And so I got in at $53 a share out of that low cheat. And I like the group, STX, WDC, Micron, this computer data storage group. They were acting well, and Pure Storage had one of the best low risk setups in that area. And then on 514, as it broke through that other cheap formation, I added more at $55 a share, so slightly raising my cost, but not a whole lot. And so this was acting well. It was trending up. And then due to the position size, I trimmed on 523. The reason for this trim was earnings were coming up and it was a 15% gain. So it was like 3 times the initial risk on the position. And yeah, so we have a tracker to calculate earning size, and given the ATR of the stock and the expected move, it made sense to lock some gains in. And so, yeah, so on earnings, it had a good earnings report, but pretty volatile. It gapped up and then came all the way back into that 21 day. And looking back in hindsight off that 21 day, it could have been an ad, but I I didn't love the big outside reversal on volume. So I just held the remaining shares. And then so as it kept moving higher, I raised my stop loss to the 21 day. And then on 6/21, I sold the rest of the position as it broke the 21 day at $64 a share. So that was around a 20% gain from the initial buy. And yeah, this held the 50-day, but overall it's losing relative strength. And since I've sold it, hasn't made any progress. So again, another one to watch in the future if it sets up better again. But overall, not really missing a whole lot there. And then Don, you pull up Owen. So this was a nice winner that turned into a scratch trade. And I think a good thing to look at your trades is if it's a winner, if it's a loser, if it's a scratch, there's always something to learn from and take away. So regardless, this was a scratch trade. This, good, you learn things and can implement new rules. So 515, I bought at $37 a share. This was day 2 of the earnings gap, and this was coming out of a stage 1 base. So that was one thing that I really liked that was catalyzed by an earnings reaction on volume. 2, the shoe company industry group, they had great charts. Deckers had an awesome earnings report. Crocs was trading really well. And Owen was my favorite name in this group due to earnings, product, stage 1 base, all those factors lined up in the decision. And then 517, I added again at $37 a share. It confirmed higher out of that post-earnings flag on volume. And it was, a lot of volume was coming into this stock. And so after that second add-on buy, it continued higher, and it just rode the 8/21 day super well. So it had a first natural reaction pullback, and then it found support at the 8 and bounced higher. And so this would have been the trim spot looking back. I was up 20% on the position. It was over a 4-hour trade, but given the stage 1 base, the expected move from the breakout was more than that, and that's how I was trading it. I was more so position trading this as I was using my stop at the low of the base. So the first red flag was when it gapped. It had a harsh gap down below the 21, and then it closed near the high day and put a hammer there, and it spent 2 days tight right there, but still no progress. And then that 4th day later, it gapped lower below the 21 day, and that was a big red flag. So my stop was the high of the base, but given a gap lower on volume below a key moving average, below a key support is also a sell rule. But I kept my original stop where it was, which was the high of the base, and then and then on 515 I sold out of the remainder at $39 a share for a 4.3% gain. So very small compared to what it was. And the other shoe stocks have also kind of starting to fall apart as well. So definitely some good tips from this trade and good just takeaways for future trades. So yeah, that was a scratch. And then the loser was GEV. And so with this one, a lot of the alternative energy stocks were acting well, and I viewed this one as the leader in the sector. I bought this one on 6/18 at $174 a share. It put up a bullish, like a big bull engulfing candle off the 21 day, and it closed near high day. So that was really good action. And, it had that big move up out of the IPO base, and it was forming another base. So I really liked the pattern, the earnings, and the group. And then on 6/20, I added to the position at around 178. It was breaking out, and I bought this in the morning as it was showing strength. But as you can see, it was a failed breakout. You never know until after the fact, right? So It closed mid-range, not the best close, but overall it wasn't acting wrong. And then the breakout after that, it tried to bounce a little bit and then failed, and my stop was the 21 day, so I stopped out on 628 at 170 share. So this was around a 4.5% loss. And yeah, this one still I think just needs more time looking back at it now, but the chart still looks constructive. Timing was just a little bit off. So small losers, big winners. That's how we roll at Revere.
Great stuff there, Connor. A lot of lessons in there. We lose at Revere. We either win or we learn. Win or learn. So we may show a negative profit or a small loss on the trade, but we don't consider it a loss if we learn something from it. We're constantly reviewing what we're doing, trying to get better. Incremental progress day by day, progress over perfection. All right, let's go to Ted now. Ted's got 4 trades. He's going to go through 2, and we're going to kick it off with CAVA, which has been a very nice winner for us.
Yep. So this trade in quarter 2 started April 26th. But before I talk about that, I first want to talk about the first trade I had. It kind of connects really well, so I wanted to discuss that in a couple lessons. I bought the earnings gap on February 27th with a half-size position. And I wrote that up until that April 1st bearish engulfing, and that's where I decided to offload 50% of the stock. And by that point, the 50-day was almost above, or it was above my cost. So I ended up trailing the rest of the position with the 50-day and got knocked out on a close below on April 19th. And looking back, I could have, in some ways it's hindsight, but I was trailing the 50-day, but the left side of the base, that first peak after the IPO was only about like 50 cents below. So in the future, if there's such a key level coinciding with where I'm trailing my stop, perhaps I can see if it holds that level. And sure enough, it did. But what the key lesson here is that I bought it back and I just dissociated myself from the previous trade. And so it formed a nice flag, and I bought it back April 26th. This time with a quarter size position though, because we kind of just went through a pullback. So I wanted to be more incremental. And the day before was a bullish engulfing oops reversal, which means it gaps down below the previous day's low and then reclaims that low. And in this case, we also took out the highs of that day too. And kind of that, I rode that up. It hit that 70-ish level and stalled for a bit and formed a handle. I didn't add on May 3rd, but I ended up adding another 50% of like the first starter position on May 9th. And so that brought me to about a half size position. And just ever since, CAVA's treated us really well in Grotection. We've just been trailing the 21 EMA so far. We did have to weather some volatility on earnings. On earnings. And that ended up closing extremely well, actually in all-time highs. So now at this point, with the 50-day catching up well above our cost, the thought is that we're just going to defend it with the 10-week and 50-day moving average. And this continues to work really well and forming another shelf now. So we're actually thinking about adding on to the position if we break out, and treat the second add as a whole new buy and keep a relatively tight stop, since the shelf is a little short for our liking compared to that first IPO base.
Great review, Ted.
So the next one,
up
Don,
is Micron.
Yep, MU. So this one, the first day I took a position was June 5th. It was coming out of this nice base that was formed on like after it gapped up on earnings March 20th. It had really nice VCP characteristics, very tight action on this right side. So that's where I took a 1/4 size position. And 3 days later, on June 10th, I made it a 1/2 size position And this trade didn't last too long, but it did give a relatively nice 17, 18% gain. And when I saw some exhaustion on June 18th, I decided to take 1/2 off. And good enough, the next day, pretty big sell off when NVIDIA also sold off after an exhaustive move. And finally, I ended up getting knocked out of the position around break even on that second piece of the position after earnings. So overall, it was still a profitable trade, but I gave back some profits on that second piece. And actually, right now, it found support, putting a hammer off the 50-day moving average. It's looking to reclaim the 8 and 21. So still monitoring this area as semis continue to be really strong. Like NVIDIA is acting really strong today. ARM is another name, Avgo. So the sector continues to remain strong since it's crucial in the build out of AI.
Excellent. Next up.
Which one are you bringing up, Don? IBIT or Lily?
Lily.
Okay. So Lily was a scratch trade. I want to go with Connor's theme of talking about 2 winners, 1 scratch, and 1 loser. In Lily, I first took a position, 1 quarter size position on May 20th. It gapped down and reclaimed the lows, so it's an oops reversal. And when it took out May 17th highs of about 775, that's when I decided to take the first position. And then the next day, it gapped up above the entire base, and that's when I decided to put on the entire full position. But my mistake here was I was a little bit too tight on my stop. My thought was it shouldn't take out that gap day's low because it was on big volume too. And with a name like Lily, institutions are supporting that heavily, especially since we broke above the Livermore 800. But unluckily, on May 28th, it shook me out, shook below that low, and it almost closed at the highs of the day. And so that knocked me out, and I wasn't able to get back in. And it's been on a pretty smooth trend recently. So that's one where I mismanaged. Could have given a bit more room, especially since my cost was about like 790, 792 area.
Good stuff. Volatility has really picked up the last 2 days with this because Bernie Sanders and Biden wrote an op-ed lambasting them for the cost of the weight loss drug, but it reacted positively and closed near the high of the day. But now today there's some a report coming out that these are tied to people having vision problems. So that's why it's pulling back today. But drugs always, there's always a wall of worry. There's always negative reports coming out. But reasonable position size and trend following will keep you out of trouble. Ted, we're going to wrap it up with IBIT.
Yep. So this was also the second trade I've had in this year. I was extremely bullish Bitcoin, and before I talk about the trade, a key lesson is that even if your conviction is extremely high, you still have to obey your stops and manage risk, because the market's opinion is always right and our own opinions are often wrong. So in this one, this is IBIT, but on a Bitcoin chart, if I remember, it undercut and reclaimed 60,000, and that coincides with that kind of middle, that trough right there, Don. Yep, at the lows of the base. And once I saw that reclaim, it came back on my radar. And in Bitcoin, it was tighter. This new pivot that formed at the lows of the base. IBIT, since it doesn't account for overnight action, there's some gaps, so it does look looser. But it was a lot tighter in the Bitcoin action. And when it took that out, I took a 4th size position on May 18th on this gap. And I wanted to be incremental because I knew I was starting lower in the base, so the probability of failure is much higher. So I started with a 1/4 size position. The next day, we had an inside day, which retested that breakout level of about 3670. So that told me that we're holding that level. So the next day, I doubled it to a 1/2 size position on May 17th. And that on that day found some more resistance around April 23rd highs. And so the following day, May 20th, I made it a 3/4 size position. And that was a pretty nice move up. And by this time, my thought was, we're going to definitely need some more time to give this base more symmetry. And that's exactly what we got. We kind of, on Bitcoin, we hit around that 72,000, 70,000 level and pulled back. And on IBIT, we reached this like 40-ish level and pulled back and started building this flag. And so when we broke out the flag, I topped off the position on May 30th to a full size position. And initially, the following day, we shook out those lows, but I was able to stay in the stock because I was incremental with my ads. My average was much lower, so therefore my stop was a lot lower as well. And I was able to stick with this position. And the position continued to work and until June 5th. And so that was when Bitcoin hit 72K and rejected it for the first time. And then 2 days later, it retested 72K and put in a bearish engulfing. And this is where I kind of went wrong. Just as I was incremental on the buy side, I should have been more incremental on the sell side as well, especially since Bitcoin didn't stage a true breakout yet. I was still trading within a range of about 60K to 74-ish K. That was like the range of the base. When I saw that, I should have probably trimmed at least a bit. I decided to stick onto the position because my stop was still just 4 to 5% lower. And to me, that was acceptable risk. But that day was definitely a bit ominous on volume as well. And the next few days, which doesn't really reflect on this chart because Bitcoin trades over the weekend, it was a pretty weak a few days of rallying. And then it got torched again. I think there's some economic data or FOMC surrounding these few days that I'm talking about. And eventually I got knocked out June 14th on a close below the 50-day. And that ended up being a very tiny loss, maybe 2% stop on a full-size position. So definitely in the ranges of acceptable risk. And as you can see, it just drifted off so far back to the lows of the base. And just always have to respect your stops. The lesson here is I was incremental on the buy side, which is good, but I should be more incremental on the sell side as well with trimming when the action in the market doesn't confirm my expectations of what it should do. Overall, though, I'm still bullish Bitcoin. It's still within this base and just putting in a bigger base now. And sometimes with volatility contraction characteristics, you will start to get tightening on the right side of the base, but if it leaks off, it just tells you it might need more time, which is what we're getting here. And so far, Bitcoin is still holding the 30-week moving average, and it's still in the firm uptrend too. And if you go on the weekly and monthly charts of Bitcoin, just still really, really positive accumulation patterns in price and volume. So I'm still watching it, but it's just not ready yet.
Good stuff, Ted. Again, no losses if a lesson comes from it. Dan, that's a nice deep dive into 8 trades that we've done recently. Mixed results on them. We talk about our losses just like we talk about our winners every night in our videos. And you can take us home from there. Oh, no, NVIDIA. I'm going to talk just very quickly about NVIDIA because of the big reversal that it had and how in this. So this big reversal day, we had plans in-house to hedge if we broke below the 8-day exponential moving average because this was what it was riding higher. So we started a hedge that day, added to the hedge this day, took profits on the hedge and got back fully long when we bounced at the 21 average, but that bounce was short-lived. What was happening is we were running into the declining. You can't see it here because price overlaps it. Every time we ran into the declining 8-day moving average, we were getting rejected. So this was an ugly day. Monday was an ugly day for it when we gapped at the open below the 21-day moving average, and we put the hedge back on that day. By the end of the day, we recovered back above the 21, and some of that hedge came off. So at this point, we were hedging half of the position. Tight inside day yesterday, but you can see what's happening today. Strong day, up 4%, But the key is that it's back above the 8-day exponential moving average. We had a discussion about this in-house yesterday. What would have to happen for NVIDIA to the talk on the street, so to speak, is that NVIDIA just got over-owned and it had a date with the 50-day moving average. We've been talking about this in the video. That 15% moved down from where we closed yesterday. So we absolutely wanted to hedge about that. Some of our taxable clients have 200 to 400% gains on this, and we don't want to sell it and blow the position out. It's much easier to hedge if the long-term trend is still intact, and that's the situation that we're in. So now I just drew this little shelf. The highs of a week ago is what would be very bullish to get back above that level. Shorter term, getting back above the moving average and having the 8-day curl back to the upside. And then if we test back the 8-day moving average and it holds, that would give us the hedge is probably going to completely or at least half come off today because of this sign of strength today. I realize the volume is lighter and it is a shortened session. So we'll make that decision within the next 30 minutes. But going forward, we want to see it get back above the highs of last week, and on any pullback, hold the 8-day moving average, continue higher. So that's how we have been handling NVIDIA, which was one of our largest positions for a significant period of time. Here's the big breakout that happened last January. Actually, in some cases, we're in it back here. These prices are representing the 10-for-1 split that took place a couple of weeks ago. So that's it from the technical side. Dan, you can take us on back home as we are near highs of the day on Wednesday, July 3rd.
All right. Thanks, team. Listen, folks, that was like drinking from a fire hose. That was awesome information, especially for you stock nerds that understand that. A couple takeaways that just from the 10,000 foot view looking down, the bird's eye view, a couple of takeaways. Number one, you can't get married to any stock. You just can't. Okay. The stocks, I get guys call me all the time on the sell side. Hey, I want to go over this stock. We represent the stock. You ought to look at this stock, or you ought to look at this stock, or this is a great idea. I have clients call me with stock tips. Folks, we don't do that. These stocks have to earn their way onto our watch list. They have to earn their way with increasing fundamentals, institutional ownership. There's certain criteria that they've got to earn. So we don't have any preconceived ideas. It's just what's popping up, what's leading, or what is showing strength. Okay, that's the first thing. And then, so they've got to earn their way with fundamentals, and then they got to be confirmed by the technicals, because just because they're a good stock with good earnings and revenue growth doesn't mean they're timely right now. That's what they're doing. Now, hindsight is always 20/20, and we really wish we had hindsight, but we don't. So what we do here, as you can see, is we're actually measuring in real time what is happening while it's happening and make adjustments accordingly versus making some broad pie chart allocation, set it and forget it, forecast, AKA guess, hope for the best, and move forward. We don't do that. And I love Ted's quote. Ted, I wrote this down. Even if you have conviction, even if your conviction is really high, you have to obey your stops. That was Ted Z, baby. Listen, folks, is your advisor going through this with you? Or are they going this in depth? Do they have this market knowledge? Or do they just want to play golf with you? Anyway, July 4th weekend. It's a great weekend, a beautiful weekend to go play golf. But then Monday, you could tell them thanks a lot and then call us. Folks, have a great, Zach's laughing over there. Have a great July 4th weekend. Be safe. And remember the reason for this holiday. Our founding fathers gave their life and their liberty and their net worth away so that we could be a free country. Let's keep it that way, and we'll talk to you. Oh, by the way, if you like what you heard, tell a friend, tell a neighbor. Just go to revereasset.com Tell them to go in the upper right-hand corner. They can subscribe, put their email address in. We're not going to bug them or spam them. It's up to them to reach out to us, and they can reach out to us, Dan@RevereAsset.com, Don@RevereAsset.com, or Ted or Connor at RevereAsset.com. You can ask for a topic, a stock, complimentary portfolio review, and you can always call us old school at 855 Real Wealth. Happy July 4th. Let's keep this country free. We'll talk to you next week on Your Money.
Not about how much you can make in the market, it's about how much you can keep.